and 25% collected in June. So June would be 70% June. So my question is, what will be the total cash collection at the end of June 30th? Simple. How? 70% will be on June because 25% of June will be collected in July. So our target is 3 months cash collection. So in 3 months, at the end of June, so second quarter, first quarter will be January, February, March. Second quarter gonna be April, May, June. Third quarter gonna be July, August, September. And fourth quarter gonna be October, November, and December. So second quarter, we are expecting that we would be receiving $905,000 in our quarter, right? And that doesn't mean that this is the rule. Sometimes it is 60-40, sometimes 50-50. If you're a new company, you don't believe in selling things on credit, so it's 100% cash, right? But mostly it's like that. You give some credit to the customers so that they can purchase from you and give you money back in one month or 2 months. That's it, right? Any question in expected cash collections? Min, Christine, Chandra, Sibade, David?
No question, sir.
Good. Okay, let's move. Now we have sales budget. From sales budget, we have also made expected cash collection, right? If we have to sell, for example, 20,000 in April, then how we are going to make? So for making purposes, we need to make a production budget, right? By the way, why can't we make 20,000 in 1 month? And next month, 30,000, we can make 30,000. No, the factory doesn't run like that, right? In factory, you have opening inventory, you have ending inventory as well, right? Recall that concept. So sometimes you have you make more and that inventory transfer to the next month as an opening inventory. So you need 30,000 in, for example, in May, and you have 5,000 left in April. So how much you make to achieve 30,000? It means in April, in May, you only need 25,000 because 5,000 is coming from previous month production. Plus, factory run on a smooth basis. If factory capacity is that they are producing 30,000 units a month, so they cannot reduce the production. They will be producing 30,000, 30,000, 30,000. So it means they're going to be opening inventory, they're going to be ending inventory as well. And depending on that one, then you realize, okay, do we need to cut the second shift, or we just increase the second shift or not? Do workers need to produce in extra shift, overtime or not? Then it is the requirement of that one. So let's just see that. Production budget. So sales budget and expected cash flow, expected cash collection completed, and now it's time to budget production. So see what's going on here. When we know that how much units we need to produce, and there comes producing these much units need how much raw material, direct material, how much labor need, how much manufacturing overhead. Then from this production budget, we will be making material budget, labor budget, manufacturing overhead budget, right? So it's all on sequence, right? So the management of the Royal Company wants ending inventory to be equals 20%. So no matter whatever you sell, you must maintain a 20% ending inventory for that month. That's it. And 20% of Sorry, 20% of following month's budget. If you are maintaining 20%, this is April, so ending inventory must be 20% of May production budget. Sorry, May sales. In May, if you want to, if you in May the sales target is 30,000 units, then 30,000, which means 6,000 units must be ending inventory in April, right? And this depends on company to company, but the Royal Company maintains this kind of stuff. So on March, 4,000 units were on hand, which means March 31st means 1st April, we have our opening inventory 4,000. Let's prepare the budget. So we know that. So we just, because ending inventory based on sales, so we just write it down sales here of each quarter. April sales 20,000 units, May sales 50,000, June sales 30,000. So did you see here the sales are not evenly distributed? In April 20,000, in May sales skyrocketed 50,000 units, and June 30,000. It means this business has a cyclical nature, seasonal nature inside, seasonal element inside, right? In May, maybe something, there's a season and people buy products crazily here. And in June, the season still there, but dropping. So now what is the ending inventory? 20% off next month budgeted sales, 20% off May sales. So it's going to be 10,000, right? Beginning inventory is 4,000. So what is the formula for how much we need to produce? Opening plus purchases minus closing minus ending, right? That is your requirement. So opening plus purchases minus, or opening plus production minus closing is your requirement, right? So if you say so like this, how much you need to produce? How much you need to produce? You need to find out total need. So you need to find out these production, how much you need to produce. So you can rearrange the formula. Rearrange the formula going to be a requirement plus the closing minus opening going to be production. How much you need to produce this month, right? So this is just a formula. So ending inventory must be 20% from the next month. Beginning inventory lies this. So how much we need to produce? 26,000. So opening is 4,000. Opening plus production minus closing in 10,000. That is going to be your required. Opening is 4,000 less closing in 10,000 we have. And the rest of the stuff going to be, requirement is going to be here. Oh, sorry. Right? So 10,000. So let's talk about the May stuff. So what is the requirement for May? Let's just see that. In May, so remember, April ending inventory will be the May's opening inventory. So that is the concept, that is logical concept. So this 10,000 is coming from as a closing, as a beginning entry from the closing entry of April. Closing entry must be maintained 20% off June, right? So that's why here. So how much you need to produce? Reading that formula, right? Now, what is the quarter? How much you need to produce in quarter? This month. What is the quarter beginning inventory? This 4,000. It's not like that you just add it here and you came up with this 20,000 here. No. Right? Not here. You can add total need here, 105,000, but ending or beginning inventory gonna be quarter start, beginning inventory, quarter end June, ending inventory. Oh, sorry, ending inventory here, 5,000. Right? So that's why the total need is gonna be 101,000. Right, everyone? It's very easy. It's not that it looks scary here, but the logic is very clear. So you guys understand? Christine, Sibade, David, Min, Chandra?
Yes.
Yes.
Okay, good.
Yes.
Now our fourth learning objective is prepare a direct material budget including, because when we are making direct material, then of course there are going to be expected cash disbursement or cash payment for material is going to be there as well, right? Okay, so at Royal Company, 5 pounds of material are used to make 1 unit of product. If 20,000 units are going to make in April, then how much material gonna need? 5 pounds for each one. Answer gonna be 100,000 units. 100,000 pounds of material gonna use, right? Similarly, we must have the ending inventory for material as well, right? And the cost of the material is 0.4 per pound. So it's very easy, very logical. You can go through the formula. You can also develop by yourself as well. So whatever suits you, just go through that. We have a beginning inventory of the April, which is 13,000 pounds of material. So let's just talk about that. So this is our production. How much we need to produce in April is coming from production budget. How much we need to produce in May, in June, coming from production budget. So material per unit pound, it takes 5 pounds to complete 1 unit. So to make 26,000 units, you make 130,000 pounds, right? So what is the ending inventory? 10% of the following month. So this 23,000 pounds needed based on May production needs, right? So remember, these are completed units. This 46,000 in May, these are sometimes students, they just multiply 46,000 with the 10%. And they say that, sir, there is no